Hey everyone, and welcome back to the channel. Have you ever dreamed of a retirement where you do and have to worry about your savings running out? A life where your money works for you, generating a steady stream of income, almost like a paycheck even when you're not working? It might sound like a fantasy, but for many, it's a reality made possible by one powerful financial tool: dividends. Today, we're diving deep into the world of dividends. We'll break down exactly what they are, how they work, and most importantly, how you can build a strategy to potentially live off them in your golden years. Grab a notepad, because this could be the most important financial video you watch all year. So, what exactly is a dividend? Let's break it down in the simplest way possible. Imagine you own a small piece of a successful local bakery. At the end of the year, the bakery has made a nice profit. Owners decide to share some of that profit with everyone who owns a piece of the business, including you. That share of the profit you receive is a dividend. Now, scale that up to the stock market. When you buy a share of a company's stock, you become a part owner of that business. If that company is profitable, its board of directors might decide to distribute a portion of those earnings to its shareholders. This payment is a dividend. It's the company's way of saying thank you for being an investor and believing in us. Here's your share of our success. These payments are typically made on a regular schedule, often quarterly, which means you could receive a payment every 3 months from each dividend-paying stock you own. It's real cash deposited directly into your brokerage account. You can then choose to either spend that cash or, and this is where the magic really happens, reinvest it to buy more shares, which in turn will generate even more dividends in the future. Now, not all companies pay dividends. Younger high-growth companies, especially in the tech sector, often prefer to reinvest all their profits back into the business to fuel further expansion, research, and development. They believe they can generate a better return for shareholders by growing the company itself, which should, in theory, increase the stock price. On the other hand, more established, stable, and mature companies, think of big names in utilities, consumer goods, or finance, often have reliable cash flows and may not have as many high-growth opportunities. So, instead of sitting on a pile of cash, they choose to reward their long-term investors by paying out a portion of their earnings as dividends. This signals financial health and stability, attracting investors who are looking for a steady income stream rather than just rapid stock price appreciation. When you're looking at dividend stocks, you'll often hear the term dividend yield. This is a simple but crucial metric. It's the annual dividend per share divided by the stock's current price, expressed as a percentage. For example, if a stock is trading at $100 per share and pays an annual dividend of $3, its dividend yield is 3%. This percentage helps you compare the income-generating potential of different stocks. Okay, so we understand what dividends are. Now for the exciting part. How do you actually build a portfolio that could allow you to live on dividends after you retire? This isn't a get-rich-quick scheme. It's a long-term strategy that requires discipline, patience, and a clear plan. The goal is to accumulate enough dividend-paying assets over your working years so that the annual income they generate is enough to cover your living expenses in retirement. Let's walk through the steps. First and foremost, you need to figure out your number. How much income do you actually need per year to live comfortably in retirement? This is a very personal calculation. You need to account for everything: housing, food, healthcare, travel, hobbies, and taxes. Let's say, for example, you determine you'll need $60,000 per year to live your desired lifestyle. This is your target annual dividend income. Once you have this number, you can start working backward to figure out how large your portfolio needs to be. Step 2 is understanding the relationship between your portfolio size, dividend yield, and your target income. Using our example of needing $60,000 per year, if you build a portfolio with an average dividend yield of 4%, you can calculate the total portfolio value you'll need. The math is straightforward. Divide your target annual income by your expected dividend yield. So, $60,000 divided by 0.04, which is 4%, equals $1.5 million. Now, I know that number might seem intimidating, but remember, this is a long-term goal. You're not trying to save $1.5 million overnight. This is the power of decades of consistent investing and compounding growth. If your portfolio has a higher average yield, say 5%, you would need a smaller nest egg of $1.2 million. A lower yield of 3% would require a larger portfolio of $2 million. This simple calculation shows why your portfolio's average yield is so important. The third, and perhaps most critical step, is building the portfolio itself. This is where strategy comes into play. You don't want to just chase the highest dividend yields you can find. A very high yield can sometimes be a red flag, indicating that the market thinks the company is in trouble and might have to cut its dividend in the future. A company whose stock price has plummeted will have a high yield on paper, but if the underlying business is failing, that dividend isn't safe. Instead, you want to focus on quality. Look for companies with a long, consistent history of not just paying, but also increasing their dividends year after year. These companies are often called dividend aristocrats or dividend kings. They are typically financially sound, market-leading businesses with durable competitive advantages. A history of dividend growth shows that the management is committed to rewarding shareholders and is confident in the company's future earnings potential. Furthermore, diversification is key. You never want to put all your eggs in one basket. Spread your investments across various sectors of the economy like healthcare, consumer staples, technology, energy, and financials. If one sector has a downturn, your income from other sectors can help stabilize your portfolio. You can achieve this by either buying individual stocks from different industries or by investing in dividend-focused, exchange-traded funds, or ETFs. Dividend. ETFs are great because they instantly give you a diversified portfolio of dozens or even hundreds of dividend-paying stocks in a single investment, which can be a fantastic and low-risk way to get started. The final piece of the puzzle, and the secret sauce to this whole strategy, is the power of reinvesting your dividends. Throughout your working years, every time you receive a dividend payment, you should use that money to buy more shares of the stock or ETF. This is called a DRIP, or dividend reinvestment plan. When you do this, your next dividend payment will be slightly larger because you now own more shares. This creates a snowball effect. Your growing number of shares generates more dividends, which buys you even more shares, which generates even more dividends. This is compounding in its purest form, in over 20, 30, or 40 years. It can dramatically accelerate the growth of your portfolio, helping you reach that target number much faster than just relying on your own contributions. It turns your portfolio into a self-fueling growth engine. So let's put it all together. Living on dividends is a marathon, not a sprint. It starts with a dream of financial freedom, gets grounded in a realistic budget to determine your target income, and is built brick by brick through consistent, long-term investing. The strategy involves focusing on high-quality companies with a history of dividend growth, diversifying across different sectors, and relentlessly reinvesting every dividend payment to let the power of compounding work its magic. When you finally reach retirement, you can turn off the dividend reinvestment and start having that cash flow sent to your bank account as your new retirement paycheck. The beauty is that your principal investment, the stocks themselves, remains intact and can continue to grow, providing a legacy for the future. It's a powerful, time-tested strategy for building lasting wealth and achieving a truly stress-free retirement. Thank you so much for spending this time with me today. I hope this deep dive into dividends has been insightful and has inspired you to think about your own financial future. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And if you want to learn more about investing and personal finance, make sure to hit that subscribe button and turn on notifications so you don't miss our next video. Until next time, happy investing.